They'll tell you silver trades at $28 an ounce, but behind the curtain, Fortune 500 giants are paying nearly twice that and still struggling to secure supply. While retail investors stare at the ticker, a parallel market has emerged. Industrial buyers aren't waiting on exchanges. They're locking in deals directly. The real question isn't if these two prices collide, but when and how violent that collision will be. What happens when the number on your screen no longer reflects reality? That's what we're breaking down today. COMEX registered silver inventories have fallen to a 9-year low, while open interest just hit a 3-year high. That contradiction cannot last. And the driver isn't China, isn't manipulation, and isn't even raw demand. It's something deeper, structural forces most analysts are missing entirely. Welcome to my YouTube channel. If these breakdowns help you cut through the noise, hit subscribe so you don't miss the next move. Today we're tackling 3 things. 1. The delivery mechanism that's breaking down right now. 2. What industrial buyers are doing behind closed doors. 3. The signals that tell us when this pressure point goes critical. Let's start with delivery. Futures markets operate on one fragile assumption. Almost nobody asks for physical metal. Typically, only 2–3% of contracts demand actual delivery. The system runs smoothly when everyone settles in cash, but when that assumption cracks, the math gets ugly fast, and we're watching it crack in real time. Here's what most people don't realize. Futures aren't warehouses, they're risk transfer systems. They exist to balance exposure, not to move metal, which means when trust in paper settlement falters, the entire structure wobbles. According to the Bank for International Settlements, global open interest in precious metals futures is 340 billion. COMEX alone has 780 million ounces in contracts, but only 32 million ounces registered for delivery. That's a 24.1 imbalance. If just 4% of holders demanded physical tomorrow, the vaults couldn't cover it. And delivery requests are already trending upward. A veteran trader told me something that stuck. We're built for paper settlement. When people start asking for metal, it's like a bank run. That analogy matters. You can be solvent on paper, but if everyone wants cash at once, liquidity collapses. Same here. Fresh data from the London Bullion Market Association shows cross-border silver transfers between London and New York dropped 62% in Q4 2024 compared to the year before. That's not noise, that's structural. Metal is getting trapped in specific vaults. The global fungibility that keeps arbitrage alive is breaking down, and when arbitrage fails, prices fragment. Translation: the price you see on your app is not the price industrial buyers are paying. That gap is widening. This isn't theory. It's happening in real markets with real money. The system depends on silver flowing freely between London, New York, Zurich, Shanghai. When that flow slows, the machine seizes. So let me ask you, do most retail investors even realize futures contracts are designed for cash settlement, not delivery? Drop yes or no in the comments, because this matters more than people think. Now here's where it gets uncomfortable. While the delivery mechanism strains, a shadow market is forming. Industrial giants aren't watching COMEX. They're signing multi-year supply deals at prices that would shock retail investors. Defense contractors, solar firms, tech manufacturers, they're paying 50–80% above spot because they can't afford production lines to stall. The World Bank's January 2025 commodity outlook revealed industrial off-exchange procurement of precious metals surged 43% year-over-year in Q4, the biggest jump since 2008. That's where the real demand is, not speculators, not stackers. Industrial buyers securing guaranteed supply. And here's the truth nobody wants to say out loud. This isn't manipulation. This is structural reality. 2 silver markets now exist side by side, and the gap between them grows wider every day. Supply chain managers are waking up to a hard truth. Just-in-time no longer works when the lifeblood of your production is silver. Put yourself in their shoes. You're running procurement for a solar panel company. Every month you need 100,000 ounces of silver to keep $50 million worth of product rolling off the line. Do you gamble on saving $500,000 by relying on futures contracts that might not deliver? Or do you pay whatever premium is necessary to guarantee your factory doesn't grind to a halt? The easy answer is cost cutting. The real answer is survival. This is why silver isn't just about investment demand anymore. It's about industrial necessity. That $28 price flashing on your trading app, that's the paper settlement number, the figure agreed upon when no one actually needs the metal. But if you're a buyer who requires physical delivery, you're paying $40, $50, sometimes $60 an ounce in private deals that never show up on public exchanges. This isn't theory, it's happening right now. Skeptics argue these premiums are temporary, that supply chains will normalize and paper and physical markets will reconnect. Sounds logical until you look at the data. China imported 185 million ounces of silver in 2024, a 34% jump year over year. The Shanghai Gold Exchange premium over London has held between 8 to 12% for months. Historically, anything above 5% signals arbitrage is broken. Metal isn't flowing where it should. Price differences aren't correcting. The global fungibility that keeps commodity markets balanced is breaking down. This isn't panic buying. It's strategic stockpiling by the world's largest industrial economy. China makes 45% of global solar panels, is scaling EV battery production, and needs silver for conductors, electronics, and infrastructure. That's why they're locking in supply at any cost. So what does this mean for you? If you're holding paper exposure, ETFs, futures, mining stocks, you need to think about counterparty risk. If delivery stress hits, will your position settle at the paper price or the physical price? Does your exposure actually give you what you think it does? Because when these two markets finally converge, it won't be slow. It'll be violent. And retail investors staring at their apps will be the last to know. Have you noticed premiums rising at your local dealer? Drop your city and what you're seeing in the comments. Mapping this fragmentation matters. It's a signal most are ignoring. Now let's take it one step further. Delivery stress is real. Industrial buyers are bypassing exchanges. But there's a third layer that makes this even more dangerous: the banking system. Because when delivery obligations collide with derivatives, contagion risk spreads in ways few are watching. Here's the reality. The Office of the Comptroller of the Currency reported in Q3 2024 that the top 5 U.S. banks hold $184 billion in notional precious metals derivatives, and 3 banks alone account for 89% of that exposure. That's concentration risk at its peak. These aren't speculative bets. They're client hedges, facilitation, market-making positions. But if delivery stress escalates, banks face operational chaos. If they can't meet client delivery requests, credibility cracks, relationships strain, spreads widen, and markets don't care about excuses. They punish weakness instantly. Execution is what matters. And here's the uncomfortable truth most won't say out loud. Fed H4.1 data shows $87 billion worth of precious metals pledged as collateral in repo and secured lending markets. At first glance, that looks like a banking issue. But once you understand how collateral chains function, the picture changes. Here's how it plays out. A hedge fund posts silver as collateral. The bank raises the haircut from 20% to 35%. Suddenly, the fund needs more margin. Without spare cash, they start liquidating other assets: stocks, treasuries, corporate bonds, anything that can be sold quickly. Pressure spreads across markets, correlations spike, and what began in silver doesn't stay contained. That's the contagion pathway. This isn't about silver's price direction. It's about what happens when doubts about deliverability surface. Trust erodes, haircuts rise, margin calls cascade. Now, let's consider the skeptical view. Maybe banks handle this smoothly. Maybe clearinghouses source enough metal to meet delivery demands. Maybe the stress resolves quietly. That wouldn't mean financial collapse. It would mean we're watching a live stress test of market plumbing. In that base case, you see temporary halts, cash settlements, position limits, reduced leverage. Markets adapt, and life goes on. But under the stress scenario, two-tier pricing becomes permanent. Exchange prices lose relevance for physical transactions. Industrial buyers secure supply through private deals. Retail investors get pushed out entirely. That's not alarmism, it's scenario planning. The World Silver Survey 2024 shows industrial demand at 539 million ounces, while mine supply sits at 843 million ounces, growing just 1.2% annually. The gap is being filled by above-ground stocks, but how long can that last? The imbalance isn't temporary, it's structural. So what does this mean for you? If your positions rely on functioning commodity markets, you need to know which fault lines to watch. My signals are straightforward. COMEX registered inventory versus open interest. Critical threshold is 0.20. We're already below it. Shanghai premium over LBMA. Sustained above 6% means arbitrage is broken. We've been at 8 to 12% for months. Repo collateral haircuts. A jump above 15% is an early warning sign. That's your canary in the coal mine. These aren't predictions, they're tripwires. Breach them, and you know the system is under real stress. That's why I track these data points, not to claim certainty, but to see pressure building before it becomes obvious. For those in finance or commodities, are you noticing stress in collateral markets? Drop seeing it in the comments if you are. Sometimes the best signals aren't in the reports, they're in what professionals avoid saying publicly. So the real question is, what do you do with this knowledge? Because information without action is just entertainment. My framework for navigating events like this isn't about guessing outcomes. It's about preparing for multiple scenarios and knowing which signals matter most when the pressure rises. That's what we'll cover next. I'm not here to scare you. I'm here to prepare you, and that's a crucial difference. Market structure events can't be timed, but they can be anticipated. You can't forecast the exact size of the move, but you can build a framework that adapts across scenarios. That's not intuition. It's structure. Step 1. Know your exposure. Paper contracts, physical holdings, mining equities, they all behave differently under delivery stress. ETFs carry counterparty risk most people overlook. Futures depend on clearinghouse solvency and settlement rules. Physical bullion comes with storage costs and liquidity challenges. Mining stocks offer leverage to price but are tied to equity market swings. None of these are inherently good or bad. They're simply different risk profiles. Step 2. Track the tripwires. COMEX inventory versus open interest below 0.20 is a red flag. Shanghai premiums holding above 6% signal broken arbitrage. Industrial procurement announcements are demand signals you can't ignore. Don't wait for mainstream media. They're always late. By the time it's on TV, the move already happened. Step 3. Separate regimes. Orderly rebalancing looks like gradual adaptation, position limits, reduced leverage, premiums compressing over months. A delivery event is sharper. Temporary halts, cash settlements, two-tier pricing, contained volatility spikes. Systemic stress is another level entirely. Cross-market contagion, central bank intervention, correlations snapping to 1. Step 4. Plan for scenarios, not predictions. Nobody knows which path plays out. Betting big on one outcome is easy. Building positions that survive multiple outcomes is harder, but smarter. Ask yourself, can your portfolio withstand being wrong on timing, even if you're right on direction? Step 5. Respect liquidity. Exiting during stress means spreads vanish. Entering during delivery events means premiums explode. The middle of a crisis is the worst time to make allocation decisions. Here's the truth. Most people treat this like a binary bet. Silver skyrockets or nothing happens. Reality is messier. You can be right about direction but wrong on timing. Right about mechanism but wrong on magnitude. Even right on everything and still lose because of position sizing. Avoid the psychological trap of certainty bias. Watching enough content makes you feel like you know the future. You don't. I don't. Nobody does. What we have is probabilistic thinking, scenario analysis, risk assessment. That's not prediction, it's preparation. Understanding the mechanism is not the same as knowing the outcome. Stay flexible. So practically, what does this mean? If you hold positions, know the counterparty chain. If you're planning entries, realize the quoted price and the execution price may diverge. If you're on the sidelines, track the threshold indicators we discussed. That's how you stay informed without getting emotional. If you've lived through delivery stress or market dislocations before, share your story in the comments. Real experience beats theory. Here's what I'm watching in the next 60 days. February industrial procurement data. If that 43% year-over-year growth continues, demand isn't slowing. March COMEX delivery month. If delivery intentions hit double digits as a percentage of open interest, we're in uncharted territory. Clearinghouse margin requirement changes. That's the canary in the coal mine. When margins shift aggressively, they're seeing stress before we do. Remember the nickel market in March 2022? Delivery stress forced the London Metal Exchange to suspend trading, cancel trades retroactively, and trigger billions in losses. History doesn't repeat, but it rhymes. If these institutional level breakdowns help you think clearly, hit subscribe. I do this every week, pulling data most retail investors never see. Drop your biggest takeaway in the comments and tell me what to cover next. Because the real question isn't whether silver goes up or down. It's whether you're positioned to survive whatever comes next. Disclaimer. This is not financial advice. These are educational frameworks. Your decisions are your responsibility.